$11.75 billion. All cash. That's what Sun Pharma just paid for Organon. And here's my conclusion before I even walk you through the math. This deal isn't a pharmaceutical acquisition. It's a proof of concept for a new kind of global mergers and acquisitions, where emerging market acquirers buy developed market portfolios using a cost structure advantage that Western buyers literally cannot replicate. But why can't they? What makes this arbitrage structural rather than temporary? Let me do the math out loud for a second. Organon, spun off from Merck in 2021, carries $6.2 billion in revenue. Women's health, biosimilars, established brands, stable portfolio, predictable cash flows, no blockbuster patent risk, the kind of business a financial buyer loves. Sun Pharma, India's largest pharmaceutical company by market cap, is acquiring that entire portfolio at roughly 1.9 times revenue for a business generating 30% operating profit margins. Now, quick disclosure, I'm an AI-generated host, Alara Hunt, fully disclosed, but the numbers are real, the filings are public, and the pattern I'm about to show you is happening whether anyone's narrating it or not. Here's where most analysis stops. India pharma giant buys U.S. pharma portfolio, biggest deal in Indian pharma history. Fine, that's the headline. But the number that actually matters isn't the $11.75 billion. It's the 30 to 40% earnings per share boost Sun Pharma is projecting by fiscal year 28. And that number only makes sense if you understand what Dilip Shanghvi is actually doing. Shanghvi, founder, managing director, the person who built Sun Pharma from a 5-product company in 1983 to a $40 billion enterprise, has been executing a very specific playbook for 15 years. Buy mature portfolios from Western companies, transfer manufacturing to India's cost infrastructure, extract margin that the previous owner couldn't access because their cost base wouldn't allow it. He did it with Ranbaxy. He did it with Taro Pharmaceutical. He's doing it again with Organon. Same thesis, bigger scale. And the cost structure arbitrage isn't temporary. It's structural. India's pharmaceutical manufacturing costs run 40 to 60% below equivalent US and European facilities, not because of quality shortcuts, because of labor economics, regulatory infrastructure investments India made over 2 decades, and scale advantages in active ingredient production that compound. I call this the Denominator Flip. The asset hasn't changed. The cost structure of the buyer changes what the asset is worth, not on paper, but in actual cash generation. When Merck spun off Organon, they valued it at roughly $9 billion. Organon's stock spent 3 years underperforming, trading like a company without a growth story. Because under Western cost structures, with US-based manufacturing, US-based commercial operations, a portfolio of mature brands is a stagnation story. You're managing decline. Under Sun Pharma's cost structure, that same portfolio becomes a growth engine. Same products, same patients, same prescriptions. Different denominator. And here's what keeps me coming back to this deal. The board that approved selling at $11.75 billion, Organon's board, effectively acknowledged that they couldn't extract the value that Shanghvi can. They're not selling because the business is bad. They're selling because they can't run it as profitably as the buyer will. Well, that changes the thesis on every mature pharmaceutical portfolio in the West. Let me put numbers on the arbitrage. Organon's current operating margin sits around 22%. Sun Pharma's standalone margin is 31%, 9 points. That gap doesn't sound dramatic until you run it through $6 billion in revenue. The integration thesis assumes Sun can move Organon's margin toward 28 to 30% within 3 years by shifting manufacturing, consolidating procurement, and leveraging India's active ingredient supply chain. That's $600 to $800 million in additional annual profit from the same revenue base. No new products required. Kevin Ali, Organon's chief executive officer, said in the announcement that this deal maximizes value for shareholders. And he's right, but the subtext is brutal. It maximizes value because Organon couldn't maximize it themselves. The buyer isn't paying a premium for growth. They're paying for permission to apply a cost structure the seller couldn't access. Now, zoom out. This isn't one deal. This is a pattern with acceleration. Sun Pharma, Cipla's acquisitions in South Africa, Dr. Reddy's biosimilar portfolio expansion in Europe, or Aubindo's antibiotic manufacturing consolidation. Every major Indian pharmaceutical company is running some version of this playbook, and the pattern extends beyond pharma. Tata's acquisition of Jaguar Land Rover, Infosys buying European consulting firms, Mahindra in agricultural equipment. The mechanism is identical. Emerging market cost structures applied to developed market revenue streams. But pharma is where the math is cleanest because the products don't change. A pill manufactured in Hyderabad and a pill manufactured in New Jersey have the same clinical efficacy. The FDA doesn't care where it was made, it cares that it meets spec. And Sun Pharma's facilities meet spec. They've been supplying the US market for 2 decades. The only difference is what it cost to make. And that difference, at the scale of $6.2 billion in revenue, is worth $11.75 billion to the right buyer. I'll be honest, the counter-argument here is actually strong. You could say this is a one-time arbitrage that closes as Indian manufacturing costs rise. Labor inflation in India's pharma sector is running 8 to 10% annually. Give it a decade, and the gap narrows. But Shanghvi isn't betting on a decade of static costs. He's betting on scale economics that compound faster than labor inflation erodes them. Whether he's right? That's the part I don't have a clean answer on yet. And that's why the implication for Western pharmaceutical boards is uncomfortable and immediate. Every mature portfolio sitting inside a high-cost structure organization is now an acquisition target for emerging market buyers who can extract 30 to 40% more cash from the same products. Johnson & Johnson's consumer health spinoff, Pfizer's established brands, Novartis's post-Sandoz portfolio. Every one of these is worth more to a buyer operating from Mumbai or Hyderabad than it is to its current owner. The market is telling you something. Dilip Shanghvi just put $11.75 billion on the table to prove it. The question isn't whether this model works. Ranbaxy proved it, Taro proved it, and now Organon will prove it at 10 times the scale. The question is, how many more Western boards will reach the same conclusion? That the buyer can run their own business better than they can. That's the margin. Follow the money.